So, beginning with you here, Monique, when we're growing up, we have these ideas of what we're going to do when we become big adults, and I imagine you did not imagine that you would be an investor, as a child. Like, what in your career started to open up this, the awareness of the opportunity of investing, and what got you interested in it?
I mean, I think it was like a lot of things. I think just my journey in general, not coming from a finance background, but then, being an entrepreneur, you're so focused on what you love doing that I don't know that the proper education ever went into to to feed me personally on what does this look like? What does this look like investing? What does this look like, from a legacy perspective? And not so much like just only understanding the work that I did or the work that my family did. And I think that I started getting curious, and it just so happened that when my curiosity was being piqued, I met Erica. I was a part of an executive MBA program, and they brought her in to teach alternative investing. And it kind of just, to be honest, it was frustrating to me to be the CEO and co founder of a successful company, but never really have too many financial options. And also, we're doing all the work, but what was what was our model based on, and how much ownership did we really have of, from equity and equality perspective of the work that we were doing. And so I just started asking a lot of these questions, and I couldn't get the answers from a lot of people, and Erica really took the time to start talking to me about things.
So, Erica, I want to pass this to you also because in reading your story, you were incredibly academically intelligent. You had that academic chops. I think you graduated from high school at 16. And you wanted to go into the medical field for a little while and found yourself in
Oh my
finance.
goodness. Do you know that that's the first time I ever, like, see, even almost 13 years later, I just learned something new about her. I did not know she graduated at 16.
Yeah.
Oh, Will really does his research.
Yes.
Yeah.
Yes. Yes. I do my research.
She's never talked about that, Will.
So yeah, like how did you start here? Because I want to talk about you guys as the couple story and how you became partners. But I want to talk first about what got you into this world. I know investment banking came after your medical journey or foray into that world. What got you here?
Yeah, thanks, Will. I appreciate that you've clearly listened to some previous
Yeah.
interviews, and it was great to see you at the last Afrotech event.
Yeah.
So, I would say that I've always been interested in entrepreneurship. Um, I was the fifth grade president of the Young Entrepreneurs Society, so was clearly thinking about it from a really young age. I think we sold friendship bracelets, which are coming back into fashion. Um, but my mom is a physician, and so I was pre-med in undergrad, and very seriously considered going to medical school. Although I loved sort of studying the sciences, I really didn't love doing sort of the labs, which are, where you have to throw on the glasses and sit in a laboratory for 3 hours in a row and titrate chemicals. And I actually also worked, I did my undergrad at UCLA, so I took the opportunity to work on the cardiothoracic transplant unit at the UCLA Medical Center to support myself while I was in college. And it was there that I started developing, a lot of relationships with the surgeons that worked there and talking about the day-to-day life. And they were all like, oh, there are more exciting things for you to do out here than be stuck in this,
Yeah.
scenario that we're in. So I started really considering looking at finance, largely based on their suggestion. Ended up changing my major to business economics, and really loved it. And was fortunate enough to get a job on Wall Street doing investment banking at Solomon Smith Barney, which is now Citigroup, out of college. Really fell in love with all the various aspects of finance, starting off in corporate finance, but then spent a few years in asset management. Did my MBA in finance at Columbia Business School, and then I was a fixed income trader for a couple of years out of business school. But it wasn't until I got into early stage venture capital that I really found my, what I call my forever home asset class, because it's such a wonderful combination of, sort of relationship building and investing in and nurturing people, and sort of the interesting, sort of security analysis side of that. We work in what's called a gray market. So, having a good understanding of securities that don't have a lot of kind of publicly available information for pricing them. And, when I met Monique, probably, I guess, about 12 years ago, I thought, wow, she is so passionate about this and so knowledgeable around, sort of the strategy and operations of really growing a company, and really was just bringing that incredible kind of energy that I think you need to really nurture and support founders when they're at that most difficult period, which is, sort of taking something from zero to, maybe the first few $1 million in revenue. So we decided to link up together, and I think that it's really been a match made in heaven for us. And we've been really fortunate to work with some really talented and amazing portfolio companies that have done the impossible of, as I like to call it, spinning gold out of straw.
Yeah.
And we'll just like Erica, both of us coming from entrepreneurial backgrounds, I think was really important to both of us, and finding like a complementary skill set as a partner. I have a completely different background, and spending, 25 plus years in entertainment, dealing with talent, dealing with creativity, identifying talent and creativity. I saw it as a very similar lane, transitioning to founders and the founding team. There's a special talent there. There's a special it factor. They have something special that they want to build, but they need kind of like that bumper system. So that's the way Eric and I really, really, where we kind of like just blended on what our idea of supporting an early stage founding team looked like. And so we both were in agreement on that. We both had different skill sets, which kind of just is like, okay, this is what venture needs right now.
Yeah, I want you to talk more about that, because there's something to be said for, coming together as a puzzle piece. Like, okay, you fit me here and you fit me there. There's a difference in being able to work together, though. There's more to it than you have things that I need. How did you guys know, or maybe you didn't know in the beginning, if this would work out, like that we could actually be in the office together, we could travel together and do deals together? How did you know?
I know for me, when I looked at Erica, like coming from a family business and coming from entrepreneurship, and even when I started my career, still being a business person and still being surrounded by my family, these things were really important to me. Like how I choose to spend my time, who I choose to spend it with, it really does matter to me, even in business. I actually think people don't think enough about that. And so I asked myself, is this someone that if I was upset with or I didn't agree with, could I see myself still wanting the relationship? And the answer was yes for me. And that is the way I measured it, is because you're not always going to agree. Business is hard. You're doing one of the riskiest concepts, investing in founding teams at the earliest stage, right? So everyone is overwhelmed with how do we make sure and ensure the success of something. And so you want to make sure that you're in partnership with someone that, for me anyways, that it felt like family.
I would love you to chime in on this, Erica.
Yeah, absolutely. So I think that we are really lucky, because one of the most important factors to being successful as a venture capital investor is that you have to do two things. You have to be contrarian and you have to be right. And really, on the contrarian portion, that's very difficult, right? Because you need to be able to see value in things that other people are potentially overlooking. And one of the tools that has helped us do that successfully is the fact that we come from very different professional backgrounds. And so we actually have very different outlooks on what's important in an investment, and how to kind of identify risk and also identify potential for reward. So I felt very lucky to meet Monique because, in my circles, given my background is, largely finance and business school and all of that, most of the people that were kind of in my, world have a very similar perspective to things that I do. So, if I were to come together with them, it would kind of be, just two lenses over each other. Whereas with Monique and I, we're able to create between the two of us a really unique viewpoint on not only how to select companies to go into the portfolio, but also how to support founders in very different ways. So I think, that is a big part of why, we're both so committed to working together. One thing that I think a lot of folks, don't understand is that, GP partnerships are kind of like more intense than even marriages. It's very serious to get into. And, you're going to be questioned a million times more before, LPs make significant capital commitments to you about the quality of your relationship and your commitment to staying together than you would by, a priest who's doing marriage counseling before you tie the knot. It's pretty intense.
I have to tell you, that's such a true statement. I think that is probably one of the number one questions we get asked is about the partnership.
Yeah, I mean, how do you answer that? Because I mean, I was thinking about a quote I heard from you, Monique, in a previous interview where you said, fundraising is not fun. And a lot of people don't realize investors have to fundraise just like founders have to fundraise.
It's interesting, Will. I personally was actually really surprised that, first of all, how deeply I'm in the founder community. You know how honest they all speak to me and transparent. And like one of the biggest things was the offense of the no. And, they took me through this process and it was still a no. And one of the things that we implemented at Rain Ventures is like this onboarding process where there's like a 2-hour session that we do with the entire team. It's mandatory, like all of their teammates. And it's like, what does it mean to be a venture-backed company? And a few of the slides, I really do deal with like the fact that we actually fundraise then deploy capital to the selected companies, just like we're asking you all questions and we're getting updates and we're talking to you about the business. We actually have an accountability to our investors. There's the traditional like, okay, Carta, but it's not very, unlikely for us to hear from LPs who contact us directly and on the spot, they want a deep dive. And, it's our obligation to do that for them. And so trying to get this for me and Rain Ventures and what Eric and I decided is that it is important not just to do the deployment, but also to educate the founders and the teams on what type of accountability, what type of portfolio are you even sitting in? What other, who are your colleagues in the Rain Ventures portfolio? What do they look like? What does this concept look like? And then here's the follow-on capital that has come. Can you all meet that standard? And these are tough conversations sometimes.
So to not enjoy fundraising, which a lot of people don't like fundraising, you still got to get good at it though. How do you get good at it?
Yeah, I mean, I don't mind fundraising.
I'll say Erica loves fundraising.
I know, Mo, you don't, but yeah, for the person who does, Erica, go ahead.
So, for me, I'll just say this and I'll let Erica talk, but for me, my whole career was built on not selling. Even when I was in the position of having to be accountable for revenue, et cetera. I always felt it easier and it made more sense to align yourself with like-minded people. It doesn't mean that questions don't come. It's a different type of question that comes. And that's always been my perspective. Erica has a very good. She's a challenge for her. She loves it. I try to preserve my energy.
So I'll just first start by saying raising money, raising institutional capital for a venture fund is very, very hard. In fact, yesterday I had a in-person sort of meeting with a new potential founder, and I was telling him a little bit about some of our LPs, and he was like, "Oh my God, how did you get those people?" I was like, "I don't know, just did." So the truth is, it's very, very difficult, and that's probably why I actually enjoy it. It's one of those things that it's just really challenging, and there's no like real playbook for. It just sort of you just have to keep sort of a brute force approach and, keep working on it. But, the most important thing is that I have learned, and one of the things that I think made me more excited, as we raised our first fund, about understanding what we're actually doing. And I actually have this really fun book right here, How to Raise for Halifax. Even though I've already done one before, I just like keep it right
I
next
like
to me.
that.
So one of the most important things is to realize that it's not like a lot of people go into it as though it's kind of like a judgment of you and your capability and whether you're a good person or not or successful, but really it's about creating a financial product that people need, right? So if you're just raising from high net worth individuals, sure, is it like, can you get them excited, can they feel like they're going to do cool things, that's one thing. But for us, when you're raising institutionally backed, is where does this fit within their portfolio, right? What's their, sort of portfolio construction right now? What's their asset allocation model? How are things changing? How are things expected to change in the future, in terms of, current venture valuations compared to public equity valuations, compared to fixed income, and, where are interest rates going? And how are we going to help them solve problems around meeting their target return for their portfolio through the financial product that we're offering and our ability to generate returns and generate cash flow? So I think once you kind of understand it a little bit more from that perspective, it does become a little bit more interesting, because
For you, it does, right?
separating it from, this is about me personally, to can I sell a really high quality financial product that has, expected returns
Yeah.
of hopefully, 30%. And then, that makes it, I think, a lot more interesting of a challenge, is how do you provide the data points, and show, give people confidence that you can achieve that. And within that, to also show that, hey, we're also people that are taking very seriously the responsibility of using this capital to invest in things that are going to create a better world
Yeah.
and a better future for everybody as long-term investors.
I love it. Monique, I want to go back to something you said, because so I have a social club that I also run, and one of the thing you said about not selling, like if this is for you, it's for you. Like I don't sell memberships. If you want to be a member based on what we provide, this is probably the place for you. If I have to sell you a membership, you're probably not the kind of person we want, and you probably don't want to be part of this. And specifically coming from creative endeavors, you probably are not in a position to sell. Either you want it or you don't, from the consumer side. But that's still, for some firms, some VC firms, which we don't have to talk about them specifically, but in general terms, they don't have to sell. They open up a fund, that fund is closed, because, they've been able to prove something or have some sort of, attraction for whatever reasons. And the reasons are what I want to talk about is how does a fund at your stage become one of those funds? Like, what does the trajectory look like so that you and others, who want to raise funds are like, look, this is a fund. I'm going to sell it. It's open, it's closed, oversubscribed.
Here's the thing, Will, is that this like instant gratification, this instant thing, this idea, I love how much access we have to technology and information, but there's also the downside of it, right? There's like this narrative that's been amplified, that in 60 seconds of a video, that literally overnight you have success.
Yeah.
And here's the harsh fact. In entrepreneurship, most companies close down. Period. End of story. I don't care what vertical you're in. I don't care what it is. The majority of companies shut down. So when you actually start thinking about what this is and what we're doing, it's super difficult. This is really hard to have a fund, to select companies, and at Rain Ventures we do fewer investments, right, than the traditional VCs. But at the end of the day, the reality is that all of this is hard. This is hard work. Most fund ones don't even do well. We're really, really blessed and fortunate that we are doing well at Rain Ventures. But the reality is that most people don't. Most founders have to shut their business down.
Yeah.
Most VC firms shut down. I mean, if we even look at how many funds were open during COVID, post George Floyd, and how many of them are gone? The majority of them are actually gone. And that is because this is really hard work. And so I think that this idea that it's gonna look pretty. And by the way, anyone who owns an early stage venture fund and they're building it from the ground up, like Erica and I, we're making sacrifices right now.
Yeah.
It's just very plain and simple. We're sacrificing now for later. And so that we can give some type of viewpoint to founders that would not necessarily have access to pitch to traditional VC firms, right? So none of this is easy. I just, that is the thing I can only say is it's just we're choosing to not give up. And this is what we chose to do over the last 12 years.
Yeah, and I also just want to really dispel the myth that, there are firms out there where it's like, oh, we opened our fund and boom, it's fully subscribed and it's done.
Yeah.
So it actually takes like the most successful firms, like when I think about people where I'm like, oh wow, you actually were pretty successful at raising capital, it generally takes them 18 months to get the fund closed. So 18 months is actually like, okay, great, you did it on a good time frame. So it takes a very long time. Number two, LPs, institutional LPs, generally want to know you for a really long time before they even contemplate making a commitment.
Yeah.
And when I say a really long time, no joke, many endowment managers who we've had conversations with will say, okay, great. Once we've known each other for 5 years, then I will think about making a commitment to the fund. So you have to have known them and they're kind of following you for 5 years before they're even going to think about making their first commitment. So any of the funds where it seems like, oh, let's say it's, I don't know, Andreessen Horowitz or Sequoia, or Excel, where it seems like, okay, well, they opened the fund and it was fully subscribed. It's because they have existing relationships with supermassive endowments who need to deploy capital on a regular schedule, but they have built those relationships with those managers over the course of, probably 20 years.
Yeah, I would say 2 decades, actually.
That's the reality. And those, asset managers, right? I'm talking about the endowments and the institutional managers who are investing in the fund. They are happy to re-up their commitments there because they don't want to take the time to get to know a whole new manager. So, I think I explained this a little bit in the, in-person interview we were at, which is that, it's really an exceptionally long-term investment. And, as I told you, Monique and I started investing together in 2013. We started building a track record, decided that we were interested in potentially being partners in a venture fund in 2015, really went to market in 2019, closed our first fund in 2021, and are just now raising a second fund because we have, sort of proven track record results. But, that's taken over 10 years and we're still considered emerging managers.
Yes.
Yeah. Wow.
And, before that, both of us had decades long experience in our respective industries. So none of this happens overnight.
So I love that take. And I wonder, and this is a question for you, Erica, because since you brought this up, on even the big ones still have to, go through these stages. There was an organization I was part of that I learned where they were going through a fundraising campaign, and there's called a quiet period, to where they don't have to publicly announce they're going through a fundraising, but they can announce at a certain stage. And let's say it's a $500 million campaign. They can announce after they've already raised 250 of that 500. So by the time they announce, oh, we're on a trajectory, we already got 250 in the bank, and you think as the reader, oh my God, they're moving amazingly fast. And so what I hear you saying, and you can translate for me if I'm not doing this right, is don't be fooled by the show. Don't be fooled by the headline.
I'd say that on average, most venture funds take 18 months or so to raise, unless you are, one of the pre-existing, top tier funds that's been around forever and you already have LP relationships, because you're not really raising money. You're just going back to the same people. Think about it this way, right? When we make when we have LPs and they invest in us and then we give them back money, right? So let's say they make a $10 million commitment to our fund, and then we return, 15 million. It's not like they can go out and spend the money, they have to reinvest it.
Yeah.
So, okay, now it's a few years later, they're like, okay, great, take the 15 million and keep doing what you're doing. So it kind of creates like a built-in system of recycling, especially if you're providing returns, right? Because endowments need to grow. And so for these very successful larger funds, as long as they've consistently, returned substantial capital to those LPs are going to continue to reinvest it and make it very easy for them to raise subsequent funds.
What's different? We'll start with you, Monique. What's different about raising money now for founders than it was 2 years ago, 5 years ago?
Well, I mean, 5 years ago, like Erica said, in 2019, we were out talking to institutions, and I think the majority of the feedback was just not really positive, just to be honest and transparent. I think I even heard a couple of times we should start a charity.
Wow.
Like, why don't we just do this as a charity?
Yeah.
And so then post COVID and post all of the George Floyd and just all of the, equity conversations and the commitment, right, to the capital, of underfunded, or, however they wanted to coin it or term it. For me, I understand that business is cyclical, concerns are cyclical. And so, that didn't last very long. And so for me, I just feel like we're pre-COVID, right?
Wow. Would you add anything to that, Erica?
Yeah, so the funding environment is much different for founders than it was a few years ago. For one, the M&A environment for the last 2 years has been close to zero. So the issue is there's not a lot of money coming out of venture capital firms in the form of distributions, right? That would then be reinvested, as I was saying, sort of in the last segment. And that's, putting a little bit more constraint on new capital available to new portfolio companies, right? So what we're still seeing is kind of this crunch, which is that, for companies where you thought, okay, maybe you're going to invest through the Series A, and then there's going to be, a Series B capital that'll come and, support the company down the road. You're seeing that, there's less of that, right? More people are saving their dry powder for their existing portfolio companies to make sure that they can get them through what's a bit of a difficult time. We're also just seeing, valuations as a whole coming down substantially. I'd say that what we call like revenue multiples, and that's how we value companies that are actually generating revenue on the sort of software side, are down from most companies 5 years 4 or 5 years ago, or especially during the pandemic, would have been valued at 20 plus times revenue. Now things are being valued at maybe like 10 times revenue if you're lucky. We're seeing in certain sectors as low as 2 to 3 times revenue, and people are much more focused on as far as like more mature companies, on, are you generating positive EBITDA, right? So people want to see companies generating positive free cash flow that don't have high burn rates. Nobody's paying up for fast growth while you're burning a lot of cash anymore. And that just really changes the valuation scenario all the way down to the pre-seed round, because generally people are hoping that the value of the company is kind of going to like double between rounds. So if valuations are kind of half as much now at exit, they're going to be pretty much half as much all the way down to the pre-seed. And we're seeing, sort of pre-seed and seed valuations happening more in the, $5 to $10 million post money range, whereas, during the peak, it was more like $10 to $20 million post money. And I think founders, are a little bit surprised by that. And it's been hard for people to digest that they're just not going to get the valuations they used to.
And by the way, in my personal opinion, the valuation should have never been what they were, right? Like, a lot of times we do hear founders in conversation complain about investors, oh, I wanted like $100 million valuation and they only gave me a 60 million or a 50 million. And I think it's, one of the educational pieces for founders is that just because someone gives you a large number, can you get to that number? Because
Hmm.
if you can't, you're going to have a down round. And, that is not a healthy thing for the founder or
That's
for
right.
the investors. And so I think like having this understanding between founder and investor of kind of what does the valuation even mean? I think that that is something that has to be have a little more time spent on with the team.
Yeah, I'm glad you bring that up because there was a quote I found from you, Erica, where you said, your team has to be amazing. We do not invest in founders who are one person shows. No one will get anything done by themselves. The team is just as important as the idea and the business model. And going back to something you talked about earlier in this conversation, you bring these founding teams in for a 2-hour session and you talk about the dynamics of the team and et cetera. What are you looking for in the co-founder dynamic?
Is that to me?
That was the Monique, because it was Monique's quote.
Oh,
Yeah.
oh, okay.
I don't even,
So
you remember saying
complementary
that?
skill.
I don't even.
Yeah, oh no, and it is. In fact, in our diligence process, founder and founding team fit is one of our heavy focuses, right? I think that especially for women who have experienced anything in corporate America before actually like coming and building their own thing, I think that a lot of times we have been taught that we have to know everything.
Hmm.
I know for myself, I was pretty much the only female and definitely the only person of color in most of the meetings during my career. And this idea of I have to know everything, I have to be perfect, I have to do everything, that notion I'm trying to help founding teams undo. And so when we're talking to founders and we're not asking normal questions. In fact, a lot of times we get the founding team saying, oh, we've never been asked that. We don't want the pretty stuff. What are the dynamics? What happens when there is a disagreement? How is your problem solving skills as co-founders? Do you all equally respect each other? That's really important. And so, not just the skill set and the talent side, but also personally, how do you all view what it means to be founders together and part of a founding team?
I love
I
that.
mean, they have
Yeah.
to build this, and the days when it doesn't feel good, how are you all looking at each other? Do you shut down? Okay, if that is your personality profile, how do we do to prevent shutdown?
I love it.
There's just a lot of things. I think to act like these things don't exist, I think is just not healthy. These things do exist. I mean, in family, think about it. In family, you have dynamics of disagreements. Of course, you're going to have that in a new company, a young company that's stressed out every day. So we don't want them to avoid it. We want them to understand how will you conflict resolve.
Love it. Love it. Finally, I want to pose this to both of you guys, and we'll start with you, Erica. There was something I saw you had said before when you were asked about your legacy, Erica, and you said all I care about is helping female founders and founders of color build billion-dollar companies that are creating great technology products and solutions in the market. As far as I'm concerned, I think that's what my legacy is going to be. That was your quote there. And when you think about the dynamics that are currently at play in this market, where it's tough, to Monique's point, like it's kind of like pre-COVID again. When you think about how hard it is to do this work, there's some wins, obviously, but what do you think about when you think about this is what I'm going to be doing for the next 10, 20, 30 years?
Yeah, I mean, so I don't actually think it's hard right now. I'm actually happy. As I was talking about this last night, there were so many people, who just got overly excited about this industry, people who didn't really like at all even understand how it works, who just kind of thought anybody can be a VC and let me just jump in here. And just because there was a lot of like momentum, so it kind of made it seem like, just like when the stock market's always going up or crypto's always going up, these people seem like, oh, I'm a genius, right? But it's like, well, it's just because we're in this sort of interesting place in the market. So to be honest, just sort of following up on what Monique said, this kind of market correction is actually really good for the market. It's not good for things to be in sort of a very overheated
Yeah, that
and
makes sense.
sort of irresponsible deployment of capital type of market where you're just like throwing money at companies and they're just spending it on all sorts of nonsense and not really creating value. And then the worst is that they're like pawning these things off on the public markets, right? Or larger companies that have more sort of diverse investor bases of people's pension funds and all of that. Like the people who end up losing in that scenario are sort of the average hardworking people who are trying to invest their retirement savings, while a lot of wealth transfer goes to mainly private equity folks, and some
Yeah.
VCs who are able to convince them that just because the company's growing 50% year over year, even though it's losing $1 billion a year, it's some great asset to purchase. So I mean, from just sort of like a fundamental overall viewpoint of the economy, like I think we're in a better place. Monique and I have always had an incredibly disciplined approach in our investing, probably because I am a New Yorker. Actually, I originally grew up in California, but
Oh, yeah.
I spent my whole career in New York doing investment banking, like actually doing discounted cash flow analysis, sort of understanding very much how to value a variety of different asset classes. And so we've always been really focused on fundamentals. And for that reason, we never got caught up in kind of like the hype and
Yeah.
the overpaying and the investing in companies that needed to burn through $100 million to get to profitability. So, we've actually been rewarded for that really diligent approach. But it's based on many decades of experience in the market, understanding market cycles and understanding like where true value is created. And for that reason, our fund one is performing in the top 5% of funds of our vintage.
It's
But
fantastic.
it's
Yeah.
because the market is correcting to a more sensible approach that we've consistently kept. And we've by and large focused on building healthy companies that are healthy not only for the investors but also for the founders and the employees, right? We're not looking to greater fool theory our way to returns on a crappy business, but what we are hoping is to build great product, to have founders that are going to see substantial personal and financial reward from what they've done, and to build great jobs for the amazing people in our community.
It's fantastic. Monique, talk about legacy.
Legacy. When I think about like just who I am as a person, just as a human being, I feel like, even in high school for this national business program, I was nominated and served as the officer of civic affairs. Um, and so when I think of who I am, I'm just of service. That's always been my mindset. I've always wanted to get somewhere so I can gather information, share it,
Yeah.
or help someone else get there. That is just who I am. I'm not going to change that about myself. And for me personally, I felt like that the heart, right, the non-paperwork side is what was missing from venture.
Mm-hmm.
Being able to have the ability to see people, to see where they are, and know that one small thing can help change the trajectory of their business, of their mindset, of an entire economy and a community. So, like impacting consciously, that's always been important to me. Leading with some type of ability to empathetically see someone and create a solution out of that is who I am. High vision, big vision. I'm very grateful that my skill set has always had me a part of something before anyone else was. That's something I take a lot of pride in.
Yeah.
It's something I try to teach to our founding community. It's something Erica and I tried to like diligently focus on, the future that we're building, right? How we want to see the future. We have an inclusive portfolio because that's how venture should have always been done, inclusively.
Yeah.
Being able to see the world for exactly what it should be is who I'm always going to be, and always fight for that, to create that world that we want,
Love that.
because we're all creators at the end of the day.
I agree. Monique, Erica, this was so much fun. Thank you guys so much for spending time with me.
We appreciate you, Will. Thank you for all your diligence. You pulled out quotes that, man, I haven't reminded of it in a minute. So
It's a pleasure. It's a pleasure doing this work, and it's a pleasure to spend time with people like you guys.
no, thank you. We're excited about Afrotech this year.
Yeah, I'll see you there. I'll see you there.
Okay. Thanks, Will.
All right, be good, guys. All right.
Thank you.